Is DCA only for Bitcoin and Ethereum, or can you use it for altcoins too? This question has been on the minds of many crypto investors, both newcomers and veterans alike. Today, we'll explore the pros and cons of dollar cost averaging into altcoins and whether it's a strategy worth considering for your portfolio. Let us start by examining why Bitcoin and Ethereum are often considered the safest options for long-term DCA strategies. These two cryptocurrencies have the largest market capitalizations and the longest operational histories in the crypto space. Bitcoin, launched in 2009, has weathered numerous market cycles and maintained its position as the leading digital asset. Ethereum, introduced in 2015, has established itself as the primary platform for decentralized applications and smart contracts. Their longevity and market dominance contribute to a level of stability and security that is unmatched in the crypto world. This doesn't mean they're without risk, but compared to newer, less established Bitcoin and Ethereum present a relatively safer option for investors looking to build wealth over time through dollar cost averaging. However, the allure of potentially higher returns often draws investors to consider DCA strategies for altcoins. There are indeed some potential benefits to this approach. Even a small, regular investment in a promising altcoin could yield significant returns over time if the project succeeds and gains widespread adoption. This moonshot potential is what attracts many investors to look beyond Bitcoin and Ethereum initially. Including altcoins in your DCA strategy can offer diversification benefits. While Bitcoin and Ethereum might form the core of your crypto portfolio, a small position in select altcoins could complement this foundation, potentially enhancing overall returns and spreading risk across different projects and use cases within the blockchain space. It's important to note that these potential benefits come with substantial risks. Altcoins are generally much more volatile than Bitcoin and Ethereum. This volatility can work in an investor's favor during bull markets, but it can also lead to devastating losses during downturns. Many altcoins have lost 90% or more of their value from all-time highs, and some have failed entirely, leaving investors with worthless tokens. The crypto graveyard is littered with once promising projects that could undeliver on their ambitions or lost. Community support. When considering DCA into altcoins, investors must be prepared for the very real possibility that their chosen projects may not survive long-term. This risk is significantly higher with altcoins than with established cryptocurrencies like Bitcoin and Ethereum. To illustrate these points, let's look at two contrasting examples from the altcoin space. On one hand, we have a success story like Binance Coin BNB, launched in 2017. BNB has seen tremendous growth, becoming one of the top cryptocurrencies by market cap. An investor who consistently dollar cost averaged into BNB from its early days would have seen substantial returns. On the other hand, we have a cautionary tale like once a top 20 cryptocurrency, Bitcoin collapsed in 2018 after being exposed as a Ponzi scheme. Investors who had been regularly buying Bitcoin through DCA lost nearly everything when the project imploded. These contrasting outcomes highlight the potential for both significant gains and catastrophic losses in the altcoin space. Given these considerations, when should investors consider including altcoins in their DCA strategy? A prudent approach is to view altcoins as a small, speculative portion of an overall crypto portfolio. Many financial advisors suggest that Bitcoin and Ethereum should form the core of a crypto investment strategy, perhaps accounting for around 80% of holdings. Altcoins, if included, might make up the remaining 20% or less. This allocation strategy allows investors to potentially benefit from altcoin growth while limiting exposure to the higher risks associated with these less established projects. It's crucial to thoroughly research any altcoin before including it in a DCA plan. Look for projects with strong fundamentals, active development teams, and real-world use cases. Remember that dollar cost averaging is about consistent, long-term investment. If you decide to include altcoins in your DCA strategy, be prepared to stick with it through market ups and downs. The volatility of altcoins can be extreme, and it takes discipline to continue investing during downturns. It's also worth considering the additional complexity that comes with managing multiple DCA plans across different cryptocurrencies. Each altcoin may have its own wallet requirements, exchange listings, and security considerations. Ensure you're prepared to handle these additional responsibilities before expanding your DCA strategy beyond Bitcoin and Ethereum. For those new to crypto investing, it's generally advisable to start with a DCA plan focused on Bitcoin and Ethereum. These cryptocurrencies offer a more stable foundation for building long-term wealth in the digital asset space. As you gain experience and deepen your understanding of the crypto market, you can then consider whether to expand your strategy to include select altcoins. Ultimately, the decision to use DCA for altcoins beyond Bitcoin and Ethereum depends on your individual risk tolerance, investment goals, and understanding of the crypto market. While the potential for high returns exists, so does the risk of significant losses. Always invest responsibly and never put in more than you can afford to lose. In conclusion, the key takeaway is this: build your core with BTC and ETH. Use altcoins with caution, Dollar cost averaging can be an effective strategy for investing in cryptocurrencies, but it's crucial to approach it with a clear understanding of the risks and potential rewards, especially when venturing beyond the relative safety of Bitcoin and Ethereum. Whether you decide to stick with the top two cryptocurrencies or expand your DCA strategy to include altcoins, remember that consistency and long-term thinking are key to success in the volatile world of crypto investing. Stay informed, manage your risks carefully, and always be prepared for the unexpected in this rapidly evolving market.